Okay, so welcome to today's class. In today's class, I'll be um, taking you guys on Forex Jagons. So this is here now, Forex Jagons. Sorry for that, Forex Jagons. So first one here now, we have our um, break of structure. So what's break of structure? Break of structure is can simply be defined as a point in the market where market takes out the previous high or the previous low in the market. So let's dive into charts. Let's dive into practical work. So this is here now. This is an uptrend market. If basically you can remember in a previous video, and if you don't know what uptrend market is, I would advise you to go watch my previous movie video so that you understand this particular video here now. So this is here now. Our uptrend market here now. Market moving in an uptrend direction. So when do we have break of structure? In our previous video, I tell you that this is a high. This here now is a high. This here now is a high. Higher high. So when we have this impulsive buy here now in the market, and market is giving us a correctional buy, a correctional sell. If this correctional sell, this our correctional sell here now, and we're expecting market to still push to the upside. So market pushing back to the upside now, and taking out this previous higher high, then that's when we have our break of structure. So in short form, we can call it our BOS. BOS simply means break of structure. Don't forget. So that's what we call our BOS. So we have a BOS here. Okay, taking out this previous higher high now, then we have our BOS. So that's the first jargon we have now. So we have our break of structure. We have this here now to be. We have this here now to be our break of structure. Our break of structure. We have this to be our break of structure. Our first jargon here now. This is our break of structure. So our second jargon here now will be change of character. So what's change of character? I tell you that in the previous video I taught you that market moves in series of market moves in three direction. Either market is buying, or market is selling, or market is consolidating. So if market is buying, we have a buy scenario in the market here now. Market will not buy forever. So and here now, this market changes from uptrend to downtrend, thereby taking out this previous, instead of giving us this correctional sell here now and continue buying, but market tests out the previous lower high, higher low, sorry. Tests out the previous higher low in the market. Then we now say that this particular market now, after you took out this previous higher low, then it started selling. And that's when we now say that this particular market here now have done what we called a change of character. And this is our second jargon here now. Change of character, or you call it an MSS, meaning market structural shift. So we can call this a chunk. Chunk simply means change of character. Either you call it a chunk or you call it an MSS, a change of character or market structural shift. So this is here, market structural, sorry, shift or an change of character. Okay, structural shift or change of character. That's what we call this here now. So we have now handled two um we now handled two this thing, two jargons. The first one we call the first one our BUS, then we call the second one our change of character. So this here now is our BUS. This here now is our BUS2. You can see it here now. It's breaking to the downside. So this here now is our BUS2. BUS. So for the downtrend here now, for we to consider something to be our BUS, simply means this correctional move here now, this impulsive, sorry, to make this mistake, this impulsive move here now. After this impulsive move, we have this correctional move. The next impulsive move in the market needs to test out the previous impulsive move. That's when we have our BS. Just have that in mind, that for you to consider for you have a BS in the market, your next impulsive move should take out your previous impulsive move, not just anyhow move, but an impulsive move. Previous impulsive. What's this? Impulsive move. So that's when you consider a particular, when you can say that this here is a BS. Your next impulsive move is at your previous impulsive move. So we also have next jargon here now to be our support and resistance. So you can basically ask yourself, how do we know when market is buying? How do we know when market is selling? That's when support and resistance comes in. So this is here now. If this market should buy, we're expecting this market should buy from this previous higher high here now. So if this market should respect here now, market has basically respect our support zone, pushing the market to the upside. So this here now is what we know as our support zone. We call this our support zone here. Call this our support zone. So this is support zone. So a support or a demand. A support or a demand zone. A support zone is basically a zone that we are expecting market to react from, support our buys. You get it now, but basically in an uptrend market, we are expecting this support zone to help us, to help this market to push to the upside here now. That's why it is called a support zone. We are expecting market to push to the upside from this particular support zone. So we also have this one here now. We also have this support zone here now. So what are we expecting this market to do? We're expecting this market to come down here now and also buy from the support zone. Same thing from here, buy from the support zone, buy from the support zone. So that's what a support zone is. A support zone helps to push markets to the upside. So If you hear support zone, it's basically a zone where we are expecting market to react from, so that we continue our we react from to start buying. So a support zone just helps a support zone is a zone that we expect market to buy from. That's just it. A zone we expect market to buy from. It must not be a market that a zone that market will buy from, but it's a zone that we expect market to buy from. Our expect We trade expectation that is backed up by our reactions. So our expectation is, as this market is in an uptrend, we are expecting this market to continue buying. This is an uptrend market. So what's our expectation in this market? Our expectation is to look out for a buy zones. So what support our expectation in the market is reactions in the market. And what is that reaction? That reaction are the key zones where market will react from and continue buying. And what do we call that key zones that will support market to keep buying in the market? That's what we call a support in the market. Hope you understand. Thank you. So moving on, we also have what we call a resistance zone. We also have what we call a resistance zone. You get it, ba? So a support zone has market to push to the upside, while a resistance zone has market to push to the downside. That's it. This is here now. This is called a resistance zone. A resistance zone. And this here now is also a resistance zone. So we have the fourth one to be a resistance zone. And the fourth one to be a resistance zone. So what's this resistance zone? This resistance zone is simply the zone we expect market to sell from. So I told you that our expectations, we trade expectations that is backed up by reaction. So our expectation is, as this market is in a downtrend position, we are expecting this market to keep selling. That's our expectation. So what marks our expectation is key zones in the market. And what are that key zone? That key zone is the resistance zone that we help this market to keep pushing to the downside. So from here now we have our key zones. You see this is our correctional buy. This is our impulsive sell, sorry. And this is our correctional buy. Then we have this impulsive sell. The previous impulsive sell here now becomes our resistance zone. Thereby, when we have this correctional buy, we are expecting market to react from the previous impulsive sell. So this market reacts from here, then dump. So that's it. That's basically it here now. Okay, what's the next one on our list? So the next one we have here now is what we called support turning into resistance. So basically in here now, I tell you guys that when market changes from takes the previous lower high or the previous higher high in the market, then we call it a break of a change of character. Hope you still remember. So change of character or a market structural shift. When this market here, instead of respecting this resistance zone, market breaks this resistance zone here now. So what do we expect? This resistance zone here now automatically becomes a supply zone. So that's when we said supply turns into resistance. So this here now automatically becomes a higher high. This here now becomes a higher high. And if market takes out a higher high, what do we now call this movement here now? We call this movement an impulsive buy. Then this correctional sell here now, we are expecting this correctional sell to react from this previous higher high in the market, and this higher high is what we call support. So get it now here now. First of all, we are expecting this market to react from this correctional sell here now, and market reacted from this correctional sell and dump. Then this here now becomes our next zone here now. This here now becomes our correctional zone here now, and this here now becomes the previous lower high. Then market takes out this previous lower high here now, and then this changes from a resistance zone to a supply zone. Hope you understand that. Then we start having our support zone. Then if market changes again, start having our resistance zone. So that's basically it. So we have this here now to be resistance turns into support. Resistance turns into support. So for here now, for the vice versa of that, we have this to be support turns into resistance. Support turns into resistance. So market should have reacted from here and start buying, but instead market breaks the support zone here now. Then we expect this support zone to become our next resistance zone here now. So that's it. Support turns to resistance. So what's the next jargon we have in the market? The next jargon we have in the market is our POI. So you hear something of these POIs. So this here now is a POI. A POI is basically what you call a point of interest. Point of interest. A point of interest is what we call a POI. So I tell you, we trade expectation that is backed up by reactions. So this support zone here now, we are expecting market, and this resistance zone here now that we are expecting market to react from becomes our point of interest in the market. What we are looking at for the market to do. So that's why it is called a point of interest. It's just a simple word, point of interest. Our focus in the market. That's it, a point of interest. So another one we have in the market is I will teach you that when we reach to these types of zones. So we have another one in the market. We have our TP and SL. We have TP and SL. So what's TP? You might have had traders saying I hit TP in this trade, I hit SL in this trade. So what's TP? TP simply means take profit. That's what I will tell you for now. A take profit. And SM is a stop loss. So why do we have TP and why do we have stop losses? So this it here now. We trade expectations backed up by reactions. Don't forget that. That's one thing that should stick to you. So this it here now. This is our expectation in this market. Market to buy from here. So if market should buy from here now, where are we expecting this market to go to? We know for every fact we are expecting this market to take out this previous high. But how sure are we that this market will take out this previous high? Or how sure are we that this market will react from this previous high and start dumping? Or how sure are we that this zone here now we hold? So that's it. So if this market did not hold, does it mean that we are going to lose all our money in a particular trade? This market here now might not hold and this take out this zone here now and start selling, or market might react from 50% of our impulsive buy and start buying again. So how sure are we that this market and this point of interest here will not hold? So that's where we have our stop losses and take profit. So if we are expecting market to buy from here, if you are expecting market to buy from here, our stop loss is somewhere here below that our expectation level being our point of interest, or below our support zone, and our take profit is at the previous high, because we already know that market will definitely come to this previous high. So our take profit is, we are targeting the previous high here now. So that's it. A stop loss is a point here now, in the sense that if we are not correct in this market, market shouldn't take all our assets we have in the market, or all our capital we have in the market. Market should just take a fixed percentage risk we allocate to this particular trade. Market should just take it, not taking everything we have as capital in a single trade. So, and our take profit is where we are expecting this market to react from. So that's basically what we called stop losses and take profit. So this here now is our stop loss, or you call it SL in short. And here now is our take profit. We call it your TP. So that's it in short. So what else do we have? We also have spread. We have spread in the market. We have commission. Sorry for that. We have spread. We have commission. So what's spread? So if okay, before we go into that, I'll just have to teach you broker. You need to understand what a broker is before we dive into spread. So this is basically what the jargons you should understand as a forex trader. This is basically this jargons you should understand the forex trader. We have our first one to be break of structure, second one to be change of market structural shift or change of character, third one to be support, our support zone, fourth one should be our resistance zone. We have our resistance turns into support, support turns into resistance. We have point of interest, we have take profit and stop losses. So that's basically it. So you should understand these jargons and know when each jargons applies in the market. That's what helps you to understand the basic concept of the market as a beginner trader. You should first of all understand the basic concept of the market before doing any other thing in the market. Your first job in the financial market is understand how it moves first. Understand how things are being done. That's the fundamental. That's the fundamental. You understand first, then you start practicing. You start practicing what you have understood. You understand the basic, you understand the advanced. So we have bullish. Yeah, we also have I've taught you about bullish, bearish. We have liquidity, we have spread, we have pips, we have TP, we have risk to reward. So I don't know if I should teach you risk to reward now, or later when we are talking about risk management. I'll teach you risk to reward. Then we have our pips. I will teach you pips in next class, when I will be teaching you spread and broker and the cycle of forex. So that's basically it for this class. Like, subscribe, and turn on the notification button for our next video. Don't miss.